In Chapter 5 of The Intelligent Investor, Benjamin Graham continues to build on his advice for the defensive or more risk-averse investor. Titled The Defensive Investor and Common Stocks, this chapter is all about helping cautious investors navigate the world of common stocks, which are traditionally considered riskier investments compared to bonds. Despite the risks, Graham argues that stocks are an essential part of the defensive investor's portfolio, offering long-term growth and a hedge against inflation. The central theme of this chapter is providing practical guidelines for selecting safe, high-quality stocks. Graham acknowledges that many defensive investors might shy away from stocks because of their inherent volatility. However, he points out that by following certain principles, even the most cautious investors can benefit from stock market investments without taking on excessive risk. Why defensive investors need common stocks. Graham starts by emphasizing why even defensive investors should consider including common stocks in their portfolios. Stocks have historically outperformed bonds over the long term, and they offer a way to protect against the eroding effects of inflation. As prices of goods and services increase over time, the purchasing power of fixed-income investments like bonds diminishes. Stocks, on the other hand, tend to rise along with inflation, as companies pass on higher costs to consumers and increase their profits. Graham suggests that avoiding stocks entirely is a mistake, even for the conservative investor. While it's true that stocks are more volatile and come with greater short-term risks, they also offer the potential for growth that bonds simply cannot provide. Without at least some exposure to stocks, the defensive investor may struggle to keep up with inflation and grow their wealth over time. However, Graham is quick to caution that not all stocks are created equal. Defensive investors must be selective, focusing on high-quality stocks that provide stability and consistent returns, rather than chasing the latest hot trend or high-flying growth stock. What makes a stock high quality? So what does Graham mean by a high-quality stock? In this chapter, he outlines several key characteristics that defensive investors should look for when selecting common stocks for their portfolios. First and foremost, Graham advises choosing companies with a long history of profitability and financial stability. These are typically well-established, large companies that have been around for many years and have proven their ability to generate consistent earnings, even during economic downturns. Companies with strong balance sheets, manageable levels of debt, and steady revenue streams are less likely to experience wild swings in performance, making them a safer choice for the defensive investor. Another important criterion is dividends. Graham argues that dividends should play a central role in a defensive investor's stock selection process. Why? Because dividends provide a steady income stream that can help offset any short-term fluctuations in the stock's price. Even if the stock doesn't appreciate much in value, the investor still receives regular payments from dividends which can be reinvested or used as income. Companies that consistently pay dividends, especially those that have a long track record of increasing their dividends over time, are often more stable and reliable than those that do not. Graham is particularly wary of companies that retain all of their earnings without paying dividends. While these companies may reinvest their profits to fuel future growth, there is no guarantee that this strategy will pay off. From a defensive investor's perspective, receiving a portion of the company's earnings in the form of dividends is a safer bet. Diversification, spreading out the risk. In addition to selecting high-quality stocks, Graham advises defensive investors to diversify their portfolios. The idea behind diversification is simple. By spreading your investments across multiple companies and sectors, you reduce the risk of any single stock dragging down your entire portfolio. No matter how carefully you select your stocks, there is always a chance that one or more of them could underperform or even fail entirely. By holding a diversified portfolio of stocks, you can minimize the impact of these underperformers. Graham recommends holding between 10 and 30 stocks in a defensive portfolio with the goal of spreading out risk while still maintaining enough focus to manage the investments effectively. It's also important to diversify across different industries and sectors. For example, if all of your stocks are in the technology sector, Your portfolio is likely to be highly sensitive to changes in that industry. If the tech sector experiences a downturn, your entire portfolio could suffer. By holding stocks in a variety of sectors, such as consumer goods, healthcare, utilities, and finance, you can reduce your exposure to any one industry and create a more balanced portfolio. The case for dollar cost averaging. One of the most valuable strategies that Graham introduces in this chapter is dollar cost averaging. Dollar cost averaging is a method of investing in which the investor buys a fixed dollar amount of a particular stock or fund at regular intervals, regardless of the stock's price at the time. This means that sometimes you'll buy when the price is high, and other times you'll buy when the price is low. Over time, the average cost of your investments will smooth out, reducing the impact of short-term market fluctuations. The beauty of dollar cost averaging is that it takes the guesswork out of investing. Rather than trying to time the market, an approach that often leads to poor decision-making, dollar cost averaging allows you to invest consistently, regardless of market conditions. It's a particularly effective strategy for defensive investors who may be nervous about the volatility of the stock market and reluctant to invest large sums of money all at once. By investing small amounts regularly, the defensive investor can build up a substantial portfolio over time without worrying about whether they're buying at the right or wrong moment. This steady, disciplined approach fits well with the overall philosophy of defensive investing, which prioritizes stability and risk reduction over short-term gains. Avoiding the pitfalls of speculation. Throughout The Intelligent Investor, Graham warns against the dangers of speculation, and this chapter is no exception. Speculation involves buying stocks with the hope that their prices will rise quickly, often based on little more than rumors, market sentiment, or short-term trends. While speculation can sometimes lead to quick profits, it's also a highly risky approach that can result in significant losses. For the defensive investor, speculation is a strategy to avoid at all costs. Graham emphasizes that defensive investors should focus on the intrinsic value of the stocks they're buying, not on short-term price movements. Intrinsic value is a measure of what a company is actually worth, based on factors like its earnings, assets, and growth potential. By focusing on companies with strong fundamentals, the defensive investor can avoid the pitfalls of speculative bubbles and market manias. Graham also warns against trying to predict the direction of the stock market. Many investors fall into the trap of trying to time the market, buying stocks when they believe prices are about to rise and selling when they think prices are about to fall. But the reality is that no one can accurately predict market movements with any consistency. Instead of trying to outguess the market, Graham advises defensive investors to stick to a long-term strategy, focusing on high-quality stocks and maintaining a balanced, diversified portfolio. Margin of safety. One of the most important concepts that Graham introduces in The Intelligent Investor is the idea of a margin of safety. This principle applies not only to enterprising investors, but also to defensive investors who want to protect themselves from the risks inherent in the stock market. The margin of safety is the difference between the intrinsic value of a stock and its current market price. For example, if you determine that a company's stock is worth $100 per share based on its earnings, assets, and growth prospects, but the stock is currently trading at $70 per share, you have a margin of safety of $30. This means that even if the company's earnings decline or its growth slows, you're still less likely to lose money because you purchased the stock at a price below its intrinsic value. Graham argues that defensive investors should always seek to buy stocks with a margin of safety, as this provides a cushion against unexpected events or market downturns. By purchasing stocks at a discount to their intrinsic value, the defensive investor can reduce the risk of significant losses and increase the likelihood of achieving steady long-term returns. Conclusion. Chapter 5 of The Intelligent Investor provides valuable insights into how defensive investors can approach common stock investing. By focusing on high-quality stocks with strong financials and consistent dividends, diversifying their portfolios and using strategies like dollar-cost averaging, defensive investors can protect themselves from the risks of the stock market while still benefiting from the potential for long-term growth. Graham's emphasis on avoiding speculation, maintaining a margin of safety, and adopting a patient, disciplined approach to investing aligns perfectly with the mindset of the defensive investor. While the stock market may be volatile, following these principles can help even the most cautious investors build a portfolio that can withstand market fluctuations and generate steady, reliable returns over time.
Thank you for watching. Share this with friends and family, and please subscribe.